another transaction here that we will all be looking at right now. So from these, we'll be looking at ledger. From the following transaction, prepare the ledger. So prepare the ledger. So we'll be looking at each transaction, preparing ledger for each transaction. And it's also the principle of double entry also applies here. So the first one, as we told you that ledger is it summarizes and it classifies all the transaction, whereby it will now be used for accounting purpose or can now be used for other further accounting preparation. So first transaction, paid insurance premium 15,000 naira by cash. Paid insurance premium 15,000 naira by cash. You know that insurance premium is the account, one of the accounts that is affected, and cash too is also affected. So I'll come here, I'll open the ledger account. Here is how the ledger account looks like. Ledger account. So we have the insurance. We open the two accounts that is affected. Insurance premium account. We have the credit and the debit. And we have the cash account. Cash account, credit and debit. So paid insurance premium 15,000 naira by cash. It means these are the two accounts that have been affected. The two accounts are being affected, and what do? Which one is taken in and which one is going out? Which one is receiving value? Which one is reducing in value? So when you pay, it means your cash is reducing in value, your insurance premium is increasing in value. So what do? You debit your insurance premium. So you come to the debit side here and you put cash. 15 with the amount, the value, 15,000. Then you come to the cash aspect, then you credit your, you now credit it here from there. You credit your cash, now put in insurance premium 15,000 naira. This is just the principle for number one. Number two, again to explain this, number one, paid insurance premium by cash. Insurance premium is taking in value, is receiving value, is increasing in value because you just increase your insurance premium, it's increasing in value. And your cash is reducing because you've taken something out from your cash account. That is why you can see that you credit your cash. Your cash is being credited based on the principle of double entry. So you credit your cash with the insurance premium 15,000, while your insurance premium, which is receiving value, you debit it with cash 15,000 naira. And the second one says received 45,000 naira from cash sales. Receive 45,000 naira from cash sales. Now you made a sale, and that's one account that will be affected, and you receive cash too. So two accounts. These are the two accounts affected. So you open your cash account, or better still, you can even continue from this same cash account you open. So from this cash account you open, you can just say, okay, cash is coming in, so cash has received more value. So you debit your cash with sales, that's the debit your cash, 45,000. This is debit entry, while the credit entry is what? The sales account. Sales account. Then we come here, cash, 45,000 naira. 45,000 naira. So you can see for every debit entry, there's a corresponding credit entry. For every debit entry, there's a corresponding credit entry. 3. Drill 20,000 naira cash for personal use. Drill 20,000 naira cash for personal use. This tells you that there's an account that is being affected, drawings account, and cash too is affected too. So your cash will reduce because you are taking money from that cash account. So it's reduced in value. It has reduced in value. That's reduced in value. You can still come here, or you can open another ledger for it. But you can still come here. So your cash account, which is 20,000, and we drew 20,000. So if it's reducing, it means you have to put it on the credit side. You have to put it on the credit side. So drawings, 20,000 naira. Then you open the drawings account itself. Then it will now be the corresponding debit entry of it, which is cash, 20,000 naira. Sold motor vehicle and received cash, 80,000 naira. You sold motor vehicle. You sold motor vehicle and received cash, 80,000 naira. So motor vehicle is going out because that motor vehicle account, that's another account, is going out, it's giving out values, it's reducing, so it will be at the credit side, and cash is coming in. Money is coming in. The value that's coming in is now the cash. Cash is coming in. So if cash is coming in, it's going to be on the debit side. If cash is going out, it's going to be at the credit side. So since you sold motor vehicle and the cash is coming in, the cash account is increasing in value. So you put motor vehicle. Motor vehicle, 80,000 naira. And you open the motor vehicle account. You know where to open motor vehicle account here. And you have cash, 80,000 naira for it. Purchase a minibus for 20,000 naira by check. You purchase a minibus. So the total account that's been affected is minibus. That one has increased in value. And check, which is bank. So when you purchase minibus, that means your minibus account, your motor vehicle account, or minibus account, let's put another one, minibus account, has increased, while your bank will reduce in value by 120,000 naira. It's reduced in value by 120,000 naira. So with that, you can open minibus account. Since you sold, so that for space, let me just give it more. Let me give it more. Okay, sorry, it's purchase, not sold. purchase minibus, so it's increased in value. So bank 120,000 naira, and your bank account, which is the corresponding credit entry, we now show minibus 120,000 naira. Every accountant, when they see this, they know that okay, you purchase a minibus through check, or it might be through transfer, and that means you purchase it. That means, and saying this, they know that money is going out from your bank account of this value of 120,000 naira. Then number 6 says paid rate 10,000 naira by cash. You paid rate. So the two accounts that's been affected is rate and your cash. So paid rate, it means your rate, the value of your rate will increase. The value of your rate will increase, and your cash will reduce. Your cash will reduce. If your cash is reducing, if your cash is going out, so it has to be at the credit side. We're still trying to maintain this cash account. So paid rate 10,000 naira. So come here, rate 10,000 naira, and we can now open a ledger for rate itself. Rate account. The corresponding debit entries on the credit side here. Then on that rate here, it will now be on the debit side here, which will now be cash 10,000 naira. 10,000 naira. Number 7, put a further 35,000 naira cash into the business. You put a further 35,000 naira cash into the business as capital. So capital account and cash account. Capital account and cash account. For this, cash is increasing. Cash has increased. Cash has come in. Money has come in. Cash has come in. Cash has increased in value. So you come here, capital, under this same cash account, capital 35,000 naira. Then you open your capital account. The corresponding credit entry, cash 35,000 naira. Number 8, paid general expenses by check. Paid general expenses by check. The two accounts affected is general expenses, and the check is bank. So one is reducing in value, one is increasing in value. Your general expenses has increased by 28,000 naira, so it's increased in value, while your check you pay has reduced in value. So when you talk about check, we're talking about bank. So because of that, your general expenses come, we still maintain the bank account. Your general expenses has reduced. Your bank has reduced rather. General expenses. How much? 28,000 naira. While you open the general expenses account, it has increased in value. As bank 28,000 naira. Number 9, goods 17,000 naira returned by Mr. Shegun. Goods 17,000 naira returned by Mr. Shegun. This is telling you that when you sold goods to Mr. Shegun, you discover that some of the goods are faulty, or some of the goods are not good, or some of the goods are not what he ordered for. He had to return it. So that's why we see goods returned by Segun. But assuming he did not return it, like we sold goods to him, now we made a sales to Mr. Segun, and from that sales, you can see from the sales which we did here, that cash came in, sales reduced. But this is now the exact opposite of sales. Opposite of sales. So anything you do from sales account, whatever you do from sales account, this will be the reversal. So goods now returned. So that is return inward. Account will be affected, and what? Mr. Segun. And Mr. Segun. That's it. So we open a return inward account. Let me do it here. Return inward account. And Mr. Segun. So, what do we do? Return inward has increased in value, and Mr. Segun has to reduce. Mr. Segun has to reduce. So, how much do we have? So, we have, in return inward, so by Mr. Segun, we have Mr. Segun, because your return inward account will increase because if you return something, so this account will increase by 17,000 naira. While Mr. Segun account, because he has returned it, it will reduce by that same amount. £17,000. Then lastly, goods bought by check, 40,000 naira. Goods bought by check. That is purchases. You bought it, that is purchases. Goods bought by check, purchases. So what will increase? Your purchases will increase, and your check, which is your bank, will reduce. So when you open a purchase account, the value of your purchase will increase because you bought some goods to the other goods you have, so it has increased. Purchase account. So it has increased. So it has increased. So bank, it has increased by 40,000 naira. And your bank, okay, you have bank there. Let's just put it straight to where bank is. Because of space. So you have your purchases. £40,000. Naira. This is just how ledger is prepared. This is how ledger is prepared. And from here, it goes straight to your trial balance. From here, it goes straight to your trial balance. You just balance it. Then how do you do it? This is the way you do it. So you come here at the end of the month, or maybe it's the month you are looking for the year. At the end of the year, you just bring in balance, carry down 15,000 naira. So to balance it here, and this is what you now come back again. Balance brought down 15,000 naira, and this is what is going to your trial balance. This is what is going to your trial balance. The same thing to this mini boss. If this is just the only thing you did, so balance carried down 120,000 naira to balance it. Then you bring it down to the following year or the following month or thereabout. You bring it down. Balance brought down 120,000 naira. This is what is going to your trial balance. Also, same thing here too. The total here is 120 plus this one's 148, 188, 188. And you have your balance balance carried down. It will now be 188 too. 188 to make it 188 to make it balanced, and you bring this balance LED to now balance brought down. Same amount, 188, and this is what goes to your trial balance. Same thing applies to rate. Same thing applies to your capital and everything. Let's look at cash itself too. So if you have 15, 20, which is 35, 45, and we have, okay, this is 45, 80, this is 125, 160. So you have 160 here. 160. This place too must be 160. So what's the difference? So I need to shift it to under this place. 160. 160. So your balance carried down will be the difference between this 160 and this total. So if you have 35, this is 45 minus 160. You'll be having one is it 160 minus 40, 160 minus 45. That will be having 115. Having 115. So balance, you now come here. This balance CD to come after these. Let's just assume, don't mind the board. Balance brought down 115. 115. 115. So this is what we go to your trial balance, and so on and so forth, and so on and so forth. And the next one we'll be looking at is our cash book.